Governments always say that there's no money for healthcare, education or infrastructure, yet $25 trillion have been printed by central banks since 2008, and private companies and banks are seemingly thriving. We're told that austerity is necessary and public spending must be slashed, but really, where did all the money go? The answer lies in the privatization of central banks and the rise of neoliberal economic policies that have radically reshaped the global financial system. What were once institutions for the public good have become profit-driven entities serving the financial elite. Today, it's more profitable for central banks to restrict the flow of money to public institutions, funneling wealth towards private capital and leaving public services starved for funds. In this video, we'll explore how central banks became tools of private interests, why the wealthiest benefit the most, and how the system now works against the public. We'll break it all down with insights from thinkers like Blakeley, Noam Chomsky, Clara Matte, and David Harvey. In next week's video, we'll explore neoliberalism in more detail, so please do stay tuned and subscribe for more from the Left Library, your go-to for simplified political theory. Part 1. The role of central banks before privatization. Before the rise of neoliberalism and the privatization of central banks, many governments used their central banks as tools to finance public projects. Central banks at this time were either state-owned or closely tied to government policy. Their main responsibility was to manage currency, ensure economic stability, and fund public goods such as infrastructure, healthcare, and education. Historically, central banks worked to stabilize the economy by setting interest rates and issuing loans to the government. This ensured that public investment could drive economic growth, particularly during times of economic downturns. Central banks were used to finance public welfare programs and large-scale infrastructure projects, which helped create stable, well-functioning economies after World War II. During this period, central banks operated under a Keynesian economic model, which emphasized state intervention in the economy to ensure full employment. The central bank and the state worked together to create jobs, stimulate demand, and fund public services. This era is now termed the golden age of capitalism. However, the 1970s saw major changes to the global financial system, promoting the rise of neoliberal policies, and these changes would have far-reaching consequences for central banks and public spending. In the past, governments could issue debt, borrow from central banks, and invest in public goods. However, under the new neoliberal model post-1970s, central banks became more focused on restricting the flow of money to prevent inflation and to preserve the wealth of the financial elite. Part 2. The shift to privatize central banks. Under neoliberalism, central banks were increasingly privatized or made independent from direct government control. The argument was that independent central banks would be more effective at controlling inflation and managing the economy. However, this shift allowed central banks to operate in the interest of private financial institutions rather than the public. What does privatization mean in this context? Well, it means that central banks began operating more like private entities, with a focus on monetary policy, so primarily controlling inflation, rather than serving as a tool to finance public investment. This shift served the interest of the financial elite, so banks, corporations, and investors, who all profited from central banks' focus on high interest rates and low inflation. As central banks became more privatized, their primary objective shifted from supporting public investment to maintaining financial stability for markets. Governments were told that they could no longer rely on central banks to issue debt or to fund social programs. Instead, they had to turn to private capital markets to raise funds, often with much higher interest rates, which made public investment more expensive. Part 3. Central banks serving private interests. As Noam Chomsky explains in Profit Over People, this shift to privatize central banks is part of the broader neoliberal project, which seeks to transfer wealth from the public sector to the private sector. Chomsky emphasizes how neoliberal policies, including the actions of privatized central banks, shift the burden of economic crises onto the working class. Central banks, which once funded public services, now prioritize profit for private banks and financial institutions, ensuring that the rich continue to get richer while public services are continually cut. This shift helps explain why we constantly hear that there is no money for healthcare, education, or infrastructure, but plenty of money to bail out banks and corporations. Privatized central banks create policies that benefit the wealthiest sectors of society. By focusing on restricting the flow of money and controlling inflation, central banks ensure that wealthy investors can protect their assets, while ordinary people and governments face higher borrowing costs. Central banks no longer function as tools for public good. Instead, they serve the needs of private capital. The primary beneficiaries of this shift are private banks and investors who profit from central bank policies designed to restrict the flow of money into the economy. Yet, these investors will, in times of economic downturn, utilize the restricted public money supply to ensure that private profits are maintained or protected. Blakeley, in Stolen, How to Save the World from Financialization, argues that central banks now operate in a way that benefits financial markets and speculative investment. The privatization of central banks means that they are no longer accountable to the public, but to financial markets, which demand low inflation and high interest rates. By keeping interest rates high and focusing on controlling inflation, central banks ensure that the wealthy can protect the value of their assets, while the general public face higher borrowing costs privately and are told publicly that there is no money for social services or public infrastructure. One of the key ways central banks ensure profits for the financial elite is by limiting the money supply. This creates artificial scarcity, making borrowing more expensive for governments and increasing the profitability of loans for private banks. As a result, governments have to rely on austerity policies to manage their budgets, cutting social services and public investment while protecting the wealth of financial institutions. In our current system, central banks have become the gatekeepers of capital, ensuring that the needs of financial markets are prioritized over the needs of the public. Part 4. The myth of no money and the rise of austerity. One of the most damaging consequences of this shift is the rise of austerity. Governments are told that they can't rely on central banks to fund public projects and are instead forced to borrow from private markets at high interest rates. This artificially creates the narrative that there is no money for social services, when in reality, central banks have deliberately restricted the flow of money to benefit private banks and investors. In Stolen, Blakeley highlights how this shift leads to financialization, which is the increasing dominance of financial markets over the economy. Central banks, operating in the interest of the financial elite, encourage governments to adopt austerity measures, cutting public spending on healthcare, education, and infrastructure, while ensuring that the wealthiest sectors of society remain untouched. John Wells expands on this idea in The Tragedy of Austerity, explaining how austerity policies are designed to protect the profits of private banks at the expense of public welfare. Central banks restrict the flow of money, making it harder for governments to finance social programs, while encouraging private sector profits through high interest loans. Part 5. Who benefits from privatized central banks? The privatization of central banks benefits private financial institutions, investors, and corporate elites. By keeping money scarce and restricting government borrowing, central banks create conditions where private banks can charge higher interest rates and make larger profits. This concentration of wealth at the top comes at the expense of the general public, who are told to tighten their belts and accept cuts to social services. The role of central banks has fundamentally shifted from serving the public good to serving financial markets. Central banks are now accountable to investors and private financial institutions, not to the government or the public. This shift explains why governments can often claim that they don't have the money to fund public goods like healthcare, education, or infrastructure, even though there is plenty of wealth in the financial sector. Since 2008, over $25 trillion has been injected into economies worldwide by central banks, with $9 trillion of that occurring since 2019. It's a weird kind of austerity where everything is cut, but the world creates more money than ever before, as wealth is redistributed en masse from the public sector into the private. In conclusion, the privatization of central banks under neoliberalism has transformed the financial system. Central banks, once tools for public investment, now prioritize profit for private financial institutions. This shift has created a system where financial markets thrive, where public services suffer from underfunding. The money didn't disappear. It was redirected intentionally into the hands of private banks, investors, and corporations. Understanding the privatization of central banks helps to explain why governments today seem unable to fund the social programs that people desperately need. The real issue isn't that there is no money. It's that the money has been captured by financial elites through the deliberate restructuring of central banks to serve private interests. We've been the Left Library, and thank you for watching today. The suggested reading from this video would be Blakeley, Stolen: How to Save the World from Financialization, Noam Chomsky, Profit Over People, John Wells, The Tragedy of Austerity, David Harvey, A Brief History of Neoliberalism, The Capital Order: How Economists Invented Austerity and Paved the Way to Fascism by Clara Mate, and Mark Blight, The History of Austerity. Again, if you've enjoyed today, please do think about subscribing to the Left Library for more simple political theory, and we'll see you next time. Thank you again.